Good afternoon. I'm Rick Levine. I'm the chair of the FinTech and Regulation practice at Polsinelli, a large United States-based law firm with over 850 lawyers and 22 offices. As we talk today about algorithms, artificial intelligence, and robotic investment advisors, I thought it might be helpful for everybody to introduce themselves. I'll just start. I started off in the late 1990s, 3 years out of university studying law, and went in with two partners to build one of the first electronic stock exchanges in the United States. We famously went to the New York Stock Exchange as 28-year-olds and tried to convince them to buy or invest in our firm, and they laughed at us. We jokingly said, someday the New York Stock Exchange trading floor will be the world's best discotheque when computerized trading takes over. They didn't take kindly to those comments, and they threw us out on the corner of Broad and Wall Street. Our firm eventually was acquired by Citibank, and I went to a firm called Knight Capital Group, now known as KCG, the largest market maker in the world. From there, I was general counsel of two joint ventures. Of the first one had 11 of the biggest investment banks in the world. Second one had 12 of the biggest investment banks in the world. And then my last stint on Wall Street, I was the global head of product development for compliance and operations for Deutsche Bank. What I really was there to do was to make sure that the algorithms and artificial intelligence did not go crazy and blow up the balance sheet of the biggest German bank and one of the biggest banks in the world. So today, as we're talking, it's always helpful to understand who's up here, and I'd love my panelists to introduce themselves so that you know who else is on our panel today.
Hi, so I'm Matt Mills. I'm the Chief Commercial Officer at Featurespace. So Featurespace is a British technology firm spun out of Cambridge University, and we're the world's leader in what we call adaptive behavioral analytics. And it's essentially a method of preventing fraud, primarily within banks, but also within insurance companies and gambling companies, that profiles individual customers and allows you to very, very accurately tell the difference between genuine behavior and fraudulent behavior.
Good morning. My name is Sean Port. I'm the Chief Investment Officer at Nutmeg. Nutmeg is Europe's largest digital wealth manager, also known as a Robo advisor.
Andrew Keegan, I'm a director at BlackRock in the multi-asset division. I work very closely with a number of robo-advisors, including one on the stage, spanning global clients interested in whether it's accessing robo-advisors or receiving asset allocation models, spanning the whole spectrum of investment strategies from quantitative to fundamental.
Hi, Sylvain Forte. I'm the CEO of Sesam. We're a fintech company of 16 people working in big data analytics for asset management, mostly for hedge funds, banks, and insurers.
So just by a show of hands, how many people know what artificial intelligence is? Okay. How many people know what robotic investment advisors are? Okay, good. How many people in the room actually use a robotic investment advisor? All right, and how many of you remember Skynet from the Terminator movies? Okay, so we're here to tell you today that you do not have to fear artificial intelligence. We are not talking about Skynet. We are not talking about HAL, the computer system from 2001: A Space Odyssey, who killed the entire crew of his ship because he had bad instructions. We're not talking about the Whopper computer from the movie War Games that thought it would be fun to nuke the entire world as a simulation. But when we talk about artificial intelligence, I'll open it up to the panel. What do you think about artificial intelligence in your business area? What does it mean for your business?
Maybe start with us. So first off, automation is really a keystone of our business, and to deliver our proposition at massive scale, you need to automate lots of parts of the process, and that helps to simplify the business and make it very cost efficient, very low cost to serve. When it comes to AI and the more interesting areas, that's really the future and how you personalize and predict customer behavior. So the algorithm is really the foundation, just the automation, but the machine learning and big data is really how you add the extra, the 2.0 version of Robo, and personalize that experience.
I guess from an investment perspective, if we think about the business that we started, 30 years ago, pioneering quantitative investing was about largely value-based investing. And I think if you look at the decay factors for some of those kind of quantitative signals, they've moved from alpha generative to, such as momentum, to being more strategic or risk premium strategies, which are much more long-term. For us, it's about innovating and about looking to machine learning, deep learning, to see how we can really go back to the alpha. And if it's not about alpha, it's about moving onwards.
And Well, artificial intelligence is actually our core business. We're kind of selling indicators that are based on artificial intelligence. We feel that fundamentally it's not just about automating tasks, it's about helping investment managers solve something that is superhuman, like investing in the stock market, something that is quite impossible. You have billions of parameters influencing the market. It's a very, very hard task. And we feel that artificial intelligence is really about providing more information to investment managers to help them make informed decisions based on this huge amount of data.
And I guess from our point of view, you know, it's really interesting because actually we started by thinking that the way in which we're using artificial intelligence helps a computer make decisions that simply there's not enough scale of people to be able to make the right decisions within a bank or a large organization. And so initially it was around trying to reduce the workload of your investigators, you know, help the system make the decision on the vast majority of cases. You guys just work on the weird stuff. But what's really interesting is that there have been a few cases with customers recently where the system has actually thought stuff was fraudulent and the investigators disagreed. And so we're running studies at the moment. And in some cases, actually, the machine is outperforming the intelligence of investigators, which is quite fascinating. So it started as for us, a sort of simplification and workflow management kind of tool. And it's ended up actually being a system that can outsmart risk.
So part of what's interesting to me about the space, leading our fintech practice, is that throughout my career, I've seen people build algorithms, intelligence systems, artificial intelligence, and they put their trust in it. They think, oh, the system's working perfectly. One of the firms I worked at, Knight Capital Group, had an algorithm that went crazy. It was after I had worked there, long after I had worked there. But the firm ended up failing. The firm ended up failing and having to merge with another firm because an algorithm went absolutely crazy and was flooding the market with orders. So when I think about what happened in Knight Capital Group, and I think about an algorithm that went crazy or an artificial intelligent engine that went crazy, how do all of you try to manage that risk when you're building these algos and then when you're deploying these algos? What are you doing to manage the risk?
Well, I think, you know, the experience that we've had is, you know, you're always going to have to kiss a few frogs, and therefore diversification of signals, diversification of strategies is important, and not placing too much emphasis on one particular algorithm. Again, you know, an algorithm is only as good as the people that design it and maintain it, and that's really important. And again, you know, BlackRock being the world's largest asset manager, $5 trillion, it's actually dwarfed by the fact that it's the world's largest risk manager. So $17 trillion of client assets through our risk management platform, Aladdin, and that's a kind of independent check and stress testing on any of our algorithms that we run. And again, we run many across different strategies. But it's very much there for the portfolio managers, if you think about the airplane analogy, to understand where the black spots, right? You know, we're looking at the markets, there's only so much predictability that we can get. Where the black spots, where the referendums, the elections that might, you know, cause things to go haywire. And that's where we then have separate, you know, independent stress testing and risk management oversight.
Yes, something similar on our side. It's really very important to understand that most of the machine learning tasks that people are building in this world are data-driven, which means there are errors. They are reproducing human-like decisions to some extent, and a human can make errors. It's very difficult to accept that a machine can make an error because we're used to rule-based system where everything in this is defined, and if the system does not have a bug, it still works. But on this system, these are statistical systems, which mean there is a rate of error that you have to accept. The goal is to minimize it as much as possible. And usually, using artificial intelligence, you are able to create systems that are more accurate than human beings, that can manage more data, but you still have to accept that there will be errors, and you have to manage the risk accordingly, using, for example, stop losses, etc., and knowing which are the limits of these systems.
And I guess for us, we're rather lucky that with fraud, it's a relatively simple final decision. You allow the transaction to go through, or you do not allow the transaction to go through. Obviously, with Robo investing, it's a far more complicated output from the model, so it's a little bit more difficult to understand the overall performance. But with Featurespace, we're lucky with that. So I guess we just look at the performance of the system in terms of how many good customers are having their cards declined when they're using transactions. Is that heading downwards? Great. And how much fraud are we spotting if that's heading downwards? Great. You know, we can also run Champion Challenger, but again, we're kind of blessed by the simplicity of the output of our system.
So for us, just like a sort of offline financial advisor, so face-to-face conversation, we're subject to the same rules. So we have the same tests from the regulator. So we have a lot of audit trails, a lot of testing of our algorithms, a lot of testing of actual client portfolios all the time, regular analysis by our head of financial advice. So we're regularly going in and doing a lot of human work, if you like, to test and retest our algorithms. When it comes to machine learning, we are using unsupervised learning in parts of the business, but that's parts where less regulated. So understanding how much we should pay to acquire a customer. That's very different from recommending an investment portfolio, managing an investment portfolio, where there's much more of an audit trail and a very clear decision tree and how we have achieved those outcomes. So unsupervised learning is obviously quite different from a regulatory perspective.
So a lot of the discussion at the conference has been what I would consider on the continuum of crypto crazy. I would say on one end we have fanatics who say, we're going to destroy the central banks, we're going to destroy the investment banks and the exchanges and the custody houses and so forth. We're going to get rid of the regulators. And then on the opposite extreme, we don't have them here, but there are people like Charlie Munger, Warren Buffett's business partner, who basically says, this is all hooey. And he rides around in a buggy with a whip and a 1980s cell phone. Where's the reality for artificial intelligence? Are the crypto crazies right that AI and machine learning and robotic investment advisors are going to destroy all of the traditional businesses? The BlackRock's going to be driven to the shore and driven
taken over by Amazon, right?
That's right, taken over by Amazon. Or is it going to be like Charlie Munger, that we're all going to be riding around in horse and buggies with 1980 cell phones? Or is it somewhere in between? I'd be interested what all of you think about that.
I think the unfortunate boring answer is somewhere in between, and it reminds me of the sort of the active-passive debate when everybody was picking sides, and the reality is we all met in the middle, or we seem to be meeting in the middle. And the way I see it, in working with clients across different spectrums, there's a lot out there, and only some of it is going to be successful. Just like robo advisors, only some of them are going to be really successful. Those that are innovating, those strategies that are innovating, will be the ones that have got a better chance at doing it. People at the end of the day, they trust what they know. We talk about customer acquisition, we talk about people really engaging, but when it comes to moving big amounts of money, people go where they trust. And when you think about the potential crisis down the line, we're not going to need too many more of them for people to start to move back to what they feel comfortable with. So we think that having that trusted brand, having that trusted backing from an investment perspective, is a key to successful outcome for clients and for businesses.
I think there's a similar perspective in our business where everyone says the future will be a hybrid version of what we have today, both offline and online advice. For us, that's just really asking for the future is going to be similar to now, with maybe video chats, and we don't think that's the case. So we don't think that the future is going to be a faster horse. I think it's going to be quite different, where data leads interactions, where it delivers personalized and predictive advice to people, rather than a very holistic face-to-face once in a year conversation. So for us, the future is very much data-driven. However, there will be clearly a place for face-to-face advice that is very much more holistic, but aimed at a much higher wealth individual. So it's not a faster horse, it's quite different for us.
And I think from our side, what's quite interesting is I challenge anyone in this room to try and find a fraud technology company that doesn't claim they use machine learning and that their machine learning isn't the best. Every single one does. And the thing that's interesting is that there's an incredibly broad spectrum, especially with things like machine learning. I mean, machine learning is not a new concept. It's been around for a very long time. Lots of businesses genuinely do use it, but it's not necessarily the most sophisticated type of machine learning. I think what's interesting will be the next generation of classification of different types of machine learning, because we do have terms coming in. So deep learning, you've got unsupervised machine learning, of course, which does actually have a meaning, which is great. But there needs to be some kind of classification to separate out the different types of machine learning, so that as a buyer of these products, I actually know what I'm getting and what's underneath the hood, because there's just too much marketing hype around these approaches at the moment.
So, go ahead, please.
No, on my side, actually, I'll be a bit more extreme. I feel that there are ways to do asset management and trading without any human intervention and on a massive scale. If you take a look at the evolution of a quant hedge fund these days and the amount of AUM that has been raised, it's obvious that there is a way to simplify the industry and to generate real alpha by gathering money that is managed only by algorithm. But I don't think it's good for everyone. I don't think that every single asset manager should have this this way of thinking and this way of automating everything. I think for most people, this artificial intelligence will still be a way to help human beings in their current work.
So I know people hate to talk about it, but being a lawyer, I have to bring it up. It's almost like being the parent, having to feed people their vegetables. Government and regulation, artificial intelligence, machine learning, and robotic investment advisors. What are you seeing in terms of the role of government? Is it helping? Is it hindering? Do you worry about it? And how do you deal with it?
I would certainly say that talking about how we use machine learning and big data with the regulator is a difficult conversation. It's something they're thinking about, but it's not an easy thing to place within the current regs. So you have to come from the regulator's perspective. They have rules, primary legislation dating from 1987 that has to be integrated into these models. So it's difficult for them to really work out how this fits. But there is a willingness to understand that this is the future and this is how they need to think about regulation. So over our last 6 years with the regulator, it's been a very collaborative conversation. They understand where the model's moving and understand they need to help have an offering that meets the advice gap. So they're clearly there, but it's a difficult thing for the regulator to put this into regs.
Anybody else want to give any comments on regulation?
Yeah, on our side, we're actually not a regulated company, so we're not that active in that space. We have had discussion with regulators who have been very interested in this and in understanding more because they are active in that field and they're trying to understand what's happening in the market, what's happening with these new fintech that are emerging. I think they're really proactive and trying to get more information, trying to understand. They're not trying to put more constraints, but simply to protect investors.
I think from the asset management side, we're obviously highly regulated, and it's something that, with MiFID II, I think stepping out of the ivory tower is important going forward. Understanding the target groups that you're designing products for, that you're in partnership with, again, is increasing, and it's an increasing burden. Of course, having scale as a business is helping you to stay, efficient in designing products and delivering products for clients, but it is increasing burden. You find a lot of people in the sort of mid-bracket space, when it comes to regulation and compliance, they're just not able to operate efficiently. And so we do see this spectrum of asset managers moving into those big scale players, technology-driven, and those sort of smaller boutique niche players that are very focused on one particular outcome or one particular target market.
Yeah, and from us, it's interesting. So most of the regulation that's relevant to the type of business that we do specifically excludes decisions that are made for the purposes of fraud prevention and stopping crime. So we're kind of protected by design with most of our customers and in most of the markets we work. In one or two markets, there's some stuff around model governance where you have to have a lot of transparency around how the systems come to its final decision. So it does slightly limit what you can do with the machine learning because you can't use true unsupervised, fully unsupervised models because it's harder to justify how the system came to a consistent conclusion and treat all customers fairly. But in most, you still have that kind of get-out clause of it's for crime and fraud reasons, so you can still use an automated decision.
I'd leave everybody with the point that you should have a dialogue with your regulators. More often than not, particularly in the United Kingdom, in Singapore, in Canada, Australia, even to the United States to some degree, with the new CFTC FinTech Lab, you're better off having a discussion with your regulator before you start a business than starting a business and having to hire somebody like me to defend you and having to give tens of millions or hundreds of millions of dollars back with a lot of these initial coin offerings, for example, that are going on that in many jurisdictions are a sale of unregistered securities. So it's a big problem, but the point I think all the panelists, we're all in favor of machine learning, artificial intelligence, robotic investment advisors. We see it as the future, but you have to proceed with caution. So we're almost out of time, but if there are questions, if you would just raise your hand, and I think there might be microphones floating around.
And all these new trading platforms, do you not think there's, dare I say it, a bubble occurring in 5 to 10 years' time where these algorithms will automatically have to trade and sell out of positions and we have a volume restriction?
So if I'm getting the question correctly, it's are we going to get to a point where algorithms and computerized trading are making decisions on trading automatically and we'll have volume restrictions that have to be placed on the activity?
Or the amount of trading activity that occurs that day because maybe a 2008 event happens and the ETFs are forced to sell and trade down. What's the protection against that?
Well, I mean, I think everybody can jump it, but my view is you're probably going to have traditional firewalls and safeguards that if there are massive movements in the market, the algorithms will have to stop trading, and they should be built to do that. And they should also, I mean, I hate to say it, Knight Capital Group was the perfect example. You need to be able to pull the plug on the algo. You need to shut the damn thing down sometimes, to be blunt. So you have to design it with that in mind, but I'd be interested what our other panelists think.
So it's worth clearing one thing up. So despite the term Robo advice, I run the investment team and we make investment decisions. So it's not an algo that runs the investment portfolios. We use a lot of automation and quantitative tools to understand markets, understand risk, but ultimately it's a human team that makes those decisions. And we also have an in-house trading team. So while they may trade with an algo, there may be an algo that answers our trade requests at the other end. There's still people there and there's still clearly safeguards and firewalls to stop the algo running amok. So we use algos to automate lots of the business, but ultimately that investment portion is run by a human.
And I just add, I mean, when you're running trillion dollars of assets, you need risk management oversight. And that's a core part of our offering, actually. It's actually a profit center for BlackRock through the Aladdin platform. And then, again, diversification of algorithms is important so that you're not relying on one particular signal. Evolving that algo or that optimization cycle that you use, again, equally as important. And stress testing it to what happens in different market conditions. You mentioned ETFs. I mean, yes, a lot of the robo-advisors are using ETFs. It's a liquid tool to get access to markets, very low cost. Those in themselves, trade, as trade in an efficient manner with extra liquidity. Of course, relative to perhaps traditional mutual funds, they're no worse off. It's obviously the underlying, and if the underlying market becomes illiquid, that's when the whole market's going to be in trouble. And we only really see that in pockets. But of course, our risk guys, they're not worried yet about some of the ETF market. At some stage, in certain pockets, yes, but again, you have the beneficial double layer of liquidity.
Other questions in the center here?
Yes, so most algorithms have been going since there's been a massive bull run in the market. How are these tested when it turns into a bear market? Because all algos are making money when there's all this false money coming in from the central banks. Anyone can almost make money that way. The real test is when things go downwards.
So the question is how we've been living in a bull market. How do we test algorithms to deal with a bear market or a declining market? I think I might broaden the question out to the audience, to our fellow panelists. Really, how do you just test these algos? How do you test your machine learning? What are some best practices that people should be implementing to make sure that the algos and the AI and the machine learning are actually functioning properly and can deal with any type of stressful event, whether it's a security breach or a market decline or a market surge?
Yeah, this problem is actually very common with machine learning, but also with any kind of quantitative strategy. You need a backtest at a certain point of time to have the right parameters to trade with the strategies. And depending on the amount of data that you have, it can be problematic. And when we are dealing specifically with alternative data, which is the case for many machine learning algorithms, the limit is always the amount of historical data that you have. And so the goal is always to be able to count on new machine learning techniques, for example, data augmentation, to be able to account for this amount of data that's as a statistical system would be considered too small to build a proper trading strategy. And there are many mathematical techniques that exist to do this. Still, the fact that the market has been bullish for quite a while is something that is quite hard. There are models, risk models that are available also to simulate what could have happened in bearish markets, even when the data is not entirely available. To give you an example, we have been trading live with clients during August 2015, when there was the crisis on Chinese markets and when the market was pretty bearish. And this was one of the best months of performance that we had. The algorithm was retrained regularly and was able to adapt to these new market consequences. And that's really what we're looking for in machine learning, not simply overfitting on a back-tested period, but being able to adapt much better than any other kind of algorithm. That's the real goal.
I mean, I'd just add to that. I mean, 2009, momentum, reversal. These were the kind of painful periods for for anyone who's a kind of quant investor. And adapting your stress testing to perhaps indicate a sort of momentum reversal signal is something that we've done, and that's something that we test to see, if we are more positive on a momentum style strategy, what is the impact if you get a sharp reversal. And then it's really about, either leaning into the outcome if you're that type of strategy, or trying to balance the risks. And again, it comes back to the customer. What's the expectation of outcome? What's the expectation of the investment strategy? Do they really understand it? Because if not, then they shouldn't be investing in a highly quantitative algorithm-based strategy.
So from our perspective, a quantitative, pure algo-driven strategy, I wouldn't say that's appropriate or suitable for a retail client. So I'd never put that as the core of a proposition. It sounds great, sounds impressive, but I wouldn't say that's suitable. And that's really important from a legal definition, whether it's suitable for a retail client. So for us, no.
And from our side, it's interesting. So there's a couple of things that we do to resolve this issue. First of all, one of the big differences in terms of how we build our models in fraud is that we don't model what fraud looks like, we model what good behavior looks like, and then we use unsupervised machine learning to see how that adapts. Now, the nature of that is by design, you're kind of protected against whatever the new fraud attack is, because it doesn't matter that you've never seen it before. It only matters that it's different from what is normal. And so that's proved to work very well. But one of the other things that we do, not every customer allows us to do this, but we send a percentage of traffic down a suboptimal route. So we'll actually make the wrong decision occasionally on purpose just to validate that the underlying algorithms are correct most of the time. Again, for us, we have the benefit of the simple, it's a yes-no decision coming out of the system, so you can do that. With more complicated type models that the other guys are talking about, it wouldn't necessarily be a good solution.
Well, we are out of time, but if you want to talk to the human beings behind the machines, I know my fellow panelists and I will be here after this panel. We'd love to chat with you. If you could please join me in thanking my fellow panelists, I would appreciate it. Thank you.